Hello and welcome. In an increasingly interconnected global economy, foreign exchange is no longer a niche topic. It is a central pillar of financial reporting. Today, we are conducting a deep dive into IAS 21, the effects of changes in foreign exchange rates. We will explore how to manage the complexities of multiple currencies, from initial transaction to final consolidation. Our starting point is the why. The objective of IAS 21 is to prescribe how to include foreign currency transactions and foreign operations in an entity's financial statements. We focus on two primary challenges: selecting the correct exchange rate and determining how to report the inevitable gains or losses. Note that while we cover translation, specific hedge accounting is left to IFRS 9, and foreign currency cash flows are handled by IAS 7. To navigate this standard, we must speak the language. There are four terms you must master: functional currency, which is your primary economic environment; presentation currency, the one your stakeholders see; foreign operations, like your overseas branches; and monetary items. Pay close attention to monetary items. These are assets and liabilities held in fixed units of currency, like cash or receivables. As we'll see, their accounting treatment is unique. Perhaps the most critical judgment under IAS 21 is determining the functional currency. It's not about where you are registered, it's about where the money moves. We look at primary indicators first. What currency dictates your sales prices and labor costs? If those are unclear, we move to secondary indicators. What currency funds your debt or holds your operational receipts? This is a facts and circumstances test that requires rigorous documentation for audit purposes. Once the functional currency is set, how do we record a transaction? At initial recognition, you must use the spot exchange rate at the date of the transaction. While the standard allows for weekly or monthly average rates as a practical shortcut, be careful. If rates are volatile, as we've seen recently in global markets, those averages may no longer be a faithful representation of the transaction. At the end of every reporting period, we perform a measurement reset. Monetary items are retranslated at the closing rate. They are live exposures. Non-monetary items carried at historical cost, like your property or equipment, stay at their original transaction rate. They are locked in. However, if you carry an asset at fair value, you translate it using the rate from the day that fair value was determined. Where do the gains and losses go? Generally, exchange differences on monetary items hit the profit or loss immediately. There is a major exception, however. If a gain or loss on a non-monetary item is recognized in other comprehensive income, such as a property revaluation, the exchange component follows it into OCI. We also see OCI used for items forming part of a net investment in a foreign operation. Now, let's move to consolidation. If you need to translate your yen-based subsidiary into Aussie dollars for the group, we follow a specific three-step process: assets and liabilities at the closing rate, income and expenses at the transaction date rates, and the resulting difference goes to OCI. This creates the foreign currency translation reserve in your equity section. What happens to that equity reserve when you sell the business? IAS 21 features a recycle rule. When you dispose of a foreign operation, the cumulative exchange differences previously hidden in OCI are reclassified, or recycled, into the profit or loss. It finally hits your bottom line as part of the total gain or loss on the sale. Can you change your functional currency? Only if there is a fundamental change in the underlying economic transactions. If this happens, the change is applied prospectively. You don't go back and restate history, you simply translate all items into the new currency using the exchange rate at the date of the change. This becomes the new carrying amount for all subsequent accounting. To wrap up, remember that IAS 21 is about capturing economic reality. In 2026, regulators are looking for deeper disclosure on significant judgments regarding currency choices. Always maintain a clear divide between monetary and non-monetary items, and monitor global economies for hyperinflation triggers. Thank you for your time today. Let's ensure our financial reporting remains as global as our businesses.